All right. Hello, everybody. You are live with me, Hone Tai, and you are on the Hone Zone. So today we're going to be talking about a little financial literacy. We're going to be talking about how to create your own little piggy bank so that you can do your deals. I'm actually going to just free flow this conversation because I didn't even think I was going to be going live, but I figured, you know what? Why not? People love when I go live and discuss different financial strategies. So I figured, let me go live. Let me talk some financial strategies. If you guys have questions, feel free to ask. So today I'm going to be talking about how. Let's rewind. So for those who don't know, I'm a lender. I help people get loans for their real estate deals. I also am an insurance broker. I help people get insurance policies. I'm a real estate investor and I'm also an educator. So for those who don't know me, there's a little bit about my background, what do I do now. But my day today has been very interesting. So it has like good things and then bad things, and good things and then bad things. And today was just like that. I take a step forward, and the step forward was okay. I had a lender. I had this deal. I was working on this $2.25 million deal. $2.25 million loan for the 17 properties. This person wanted to get a loan for these 17 properties. Some of that money was for cash out. Some of that money was for construction. It was a unique loan, a good sized loan, $2.25 million. And with that loan, I I am going to be brokering that loan. And then the first lender that I was going to use was like, yeah, I'm all about it. I'm going to do it. And then they got bombarded with the SBA loans, the PPP loans, as you guys know it. So all the banks actually were pretty bombarded with all of the different loans that were happening. So then a lot of lenders were like, okay, we're not going to be doing loans right now. And then I'm like, oh. And then this one lender was like, okay, we're still in. And then they were like, but get back to us next week. And then next week came and I called them and they're like, okay, get back to us next week. I'm like, all right, I'll call you next week. And then they just emailed me today and like, Hone, we're not interested in doing the loan right now because of this and that and that and that, whatever. At the end of the day, it just means can't do it. Okay, no problem. I have many lenders. So I call another lender and this person's very interested. So he's like, yep, send me the package. I'm interested. We're opening up our financing again. So let's do it. And I was like, all right, sweet. Like able to save the deal. Great. So then I got that one secured. So then I move on with my day. And then I have another lender again. Lender falls apart and it's like, hey, we can't do this loan. And they said this a couple of months ago. And then today I get a phone call and it's like, hey, we're interested in giving you that loan again. Right. I'm like, oh, just give us this paperwork and this and this and this. And then we're good to go. And I was like, yes, let's do it. Right. Let's do it. So I have this other loan that's happening. And then another loan that I was working on for $450,000. That lender decided to pull out. This pandemic is really disrupting things. I don't know if you guys are feeling it. I mean, obviously, right? You guys are feeling it, but this pandemic it's gonna test you. It doesn't matter what business that you're in. It's going to test to see if you can survive because with every business, you're going to take bumps, you're going to take hits, and it's going to say like, okay, let's see if you really deserve to be in this business. And it's being tested. I'm being tested. So then that lender fell apart, and I was like, okay, well, I got to find a home for this new loan. And so that's what I've been working on. And I was just like, oh, all right, well, if this business were easier, then there would be more people doing it. And if there were more people doing it, then it would just be more competitive. And then it would be hard again, right? So I am in this business because I'm good at what I do. And when I'm tested, I will push back. So life is going to push on me and I'm going to push back, right? And that's how it goes. But I can see why people quit. I can see why people quit anything. Things are difficult. I don't know if you guys realize that, right? But things are difficult in general. So people are keep pushing. Things are going to push on you, and it's going to test to see how resilient you are. But let's keep on going. Enough with my problems. That's just my everyday. I know I post on Facebook and things like that, and it may seem like, oh, Hone's got all of it handled. I mean, I got some stuff handled, but I'm not all together. I'm not 100% there yet. Things happen to me, and I bounce. I try to bounce back as easy as best I can. But anyway, so let's talk about some hot topics now. So my life insurance business, though, has been doing very well. And for those who don't understand life insurance, it is not just insurance for when you die. Okay, so that's how the poor and the middle class look at this. They think, "Oh, life insurance. Oh, that's that stuff you buy when you think you're going to die, and then it's going to pay your family when you die." And to some degree, you are correct, but that is how the poor and the middle class look at it. The rich people, how they use life insurance is completely different. So think about it like this. If I pass you a basketball, you may dribble it down the court and then you may shoot it, and that's that, right? But you give the basketball to an NBA player, that person dribbles, crosses over, he does like trick shots and can do all kinds of things. Like Harlem Globetrotter is a perfect example. They can do amazing things with the same basketball. Give you the basketball, you're trash. Give them the basketball, and they can wow a whole crowd. So with life insurance, it's the same thing. The poor and the middle class take life insurance and they just dribble the ball down and shoot it. Whereas a rich person takes a look at life insurance and they see it as a way to hide their money. It's a vehicle, right? It's a vehicle for them to hide their money. And what I mean by that is don't think about life insurance as this thing that you buy and then when you die you get paid. It's not just that. It's more than that. What it is where if you live and not die, this life insurance has a bucket, right? We call it like a cash capture or wealth capture account. And it's a bucket where money is captured in there. So you pay for your premium. Some of the money goes towards death benefit, but then some of the money goes towards your life benefits, the benefits that you receive while you're alive. You put the money in there, and while it's in there, it is growing at a super fast clip. It is growing and growing and growing and growing and growing. Now, and I'll pull up some numbers, but just remember, you put the money into the life insurance, it goes into this cash bucket, and it's growing at a really fast rate. And the reason you want to do that is because right now, with the money that you have right now, you're holding it somewhere. So for some of you guys, your money is in your savings account. Some of you guys, you put your money in your checking account, right? And those are okay places. But the problem is with the savings and checking, it doesn't offer you any asset protection. So if someone sues you, the creditor can go after the money that's in the bucket, right? So there's that. And then people can see it. It's like it's right there. And it's not growing. Your savings account is maybe growing at 1%, and your checking account is most likely at 0. So it's not growing. I put a funny little meme joke thing up the other day, and it says, uh, what what looks like a dollar but is worth less or something like that. And it says the same dollar but tomorrow, meaning inflation is eating away at it. Your dollar is getting less and less valuable as the time goes on. And we have to prevent that, right? We have to prevent that. So what's another place that you can put your money? Now, some people put their money away in their 401k. The thing I don't like about your 401k is it's tied to the Wall Street casino, right? It's tied to the Wall Street casino, meaning your 401k, it goes up and then down and then up and then down. That's like playing roulette and putting it on red, and then maybe it won, but then the next time you put it on red, it goes down and it goes up and down, and that's just how it is. That's the Wall Street casino. And that's what your 401k is tied to, unfortunately. And you guys realize that. It's just that you don't know that you have any other options. That's the real thing, right? Ask yourself, why do you put money in your 401k? I don't know if you've ever asked that. It was just something that you do, right? And people are like, oh, of course, I put my money in my 401k because I need a retirement account. My job's not offering a pension. Okay, but is that the only place to put money for your retirement? And even if it's okay, so let's say you're going okay, it's not the only place I can put it. Is it the best place to put it? Would you want to risk your whole entire retirement on the performance of that Wall Street casino? Right? If it goes up, great, but what if it goes down? Does it go down? Obviously, we're sitting in a recession right now, a little pandemic going on, right? Tied to the Wall Street casino. We don't like that. But again, I'll ask you the question and feel free to leave the comments, right? Leave the comments in the chat box. But why is it that you guys do that? Why is it that people, let me make sure that the chats are open because sometimes they're not. Oh, okay. I got to change something real quick. All right. should be cool. Let me make sure that chat. Okay. So fixed it. Okay. All right. So now the back to it. 401k. Why do you put your money into your 401k? Why? Because everybody else told you to. Think about it. You don't question its performance. You don't even know what your money is invested in, do you? Do you? Right? You don't have this downside protection. You have potential upside. And yes, it goes up for sure, right? It does go up, obviously, but it does have that downside. It does have that downside. And if that downside happens when you want to retire, then what? It sucks. It sucks. You're taking the money out when you're at a loss and all that stuff. So then I ask you guys, is there something better that you can do with the money? Right? Is there something better that you can do with the money? So again, the rich people look at the life insurance thing. And so this is what they put their money in. So think about it this way. You're going to put money into this account. Some of it is going to go into the death benefit, as you all know about, right? That's the part where if you die, your family gets paid and all that. That's not the sexy part. That is not the sexy part. The sexy part is that you put your money into the cash value part. That cash value part grows and grows and grows at a really rapid pace, and it's protected against creditors. It's protected against the people who want your money. That's the cool part. That part should cost extra. Let's say you had a checking account, just your run-of-the-mill checking account, and you put your money into your checking account. And then pretend like your banker said, hey, do you want to protect your money? Do you want to block this? Like, we have this button that we can press and it will block your money. Would you like that? And you're like, yeah, of course I'd like that. And they said, well, that's an extra 5%, So whatever money you put in there, 5% goes towards blocking your account. Some people would pay that, right? Ask yourself, would you pay that? Pay 5% to block your money from creditors, block your money from being taken in a lawsuit, block your money from getting taken from a divorce, right? So would you block your money, or would you pay 5% to block your money? Well, guess what? Your life insurance can do that, right? The money that you put into your life insurance right there, it'll block your money 5%, but it doesn't even cost the 5%. That's the cool part. It's just built into it. That's how the life insurance people do it. That's why the rich people, when they look at life insurance, they think differently, right? These tools are available to everybody. They're available to everybody. But the rich look at the tools and use them differently, kind of like a basketball player uses a basketball differently than you could, right? They can spin it on their finger, right? You may not be able to do that, right? It's not that it's a different basketball. It's just that there's a different skill set. And so rich people use their skill sets to their advantage, right? It's conversations that they have. How do they find out about this kind of stuff? How come you don't know about this stuff, right? Because no one taught you. How come nobody taught you? Is it because it doesn't exist? Or is it that you just don't hang out with people who talk about it? And I think it's because you don't hang out with people who talk about it. And that's okay. I mean, that's how it is. Most people don't know about it, right? But there's all these strategies. We talk about self-directed retirement accounts, right? Your 401ks, your IRAs. We talk about in my real estate school or group. If you guys want to come to the real estate group, you totally can. But if in our classes, what we talk about are people who use their retirement accounts to invest in real estate. Now, if you tried to invest in real estate with your 401k, you couldn't do it. Right? So you're like, oh, you can't do that, huh? No. I can. You can't. And I can because I know what I'm doing. And it has nothing to do with the amount of money you have. That's the thing. It has nothing to do with how much money you have. It's all about whether or not you know how to use the tool. So the same thing with the insurance, right? Same thing with the life insurance. It's not that you're not allowed to. It's just that you didn't know you could. Big difference, right? So again, people use life insurance. They put the money into this cash value. They put the money into the cash value. The cash value grows at a rapid clip. When you're nearing retirement, remember this insurance, right? Though it's called life insurance, it's not for your death. Okay. And that's the hardest part, to get your brain to I have to unwind your brain. and then put it back together, right? So when I say life insurance, you guys just think death. I want you to picture that you're going to have this life insurance policy till the age of 90 or whatever age you are when you die. Okay. So you're going to have it much, much into the future. So when you're, let's say, the age of 70, we're going to design the policy where you start pulling the money out of the policy. You're going to pull the money out of the life insurance policy to fund your retirement, just like what you would be doing with your 401k. Same thing. The money that's in your life insurance policy, you're going to be pulling out completely tax free. Your 401k, you're going to have to pay taxes on that money, right? I say right, but maybe you don't even realize that. Did you know? Now I'll start it this way then. Did you know that when you retire, the money you pull out of your 401k is going to be taxed? Well, it is. It is. For those who don't know, welcome to adulthood. When you go to retire, you're going to have to pay taxes on your 401k. So when you're looking at your 401k and you're like, wow, I got a lot of money in there, cut that bad boy in half because you're going to have to pay taxes on it. Well, with the insurance, though, with the life insurance, as you've been putting money away into it, it is not going to be taxed when you access that money. And that's the cool part, right? You're going to be receiving that money completely tax-free. And I know I talk about taxes a lot. All right. In all of my lives, you'll see that I talk about taxes a lot. Taxes are a common theme. Do you know why I talk about taxes so much? Because that's going to be one of the biggest bills that you pay in your lifetime. And if you do nothing else but focus all of your attention on how to reduce taxes, you will be so much further ahead than everybody else. This is how the rich play the game. They focus on reducing their taxes. I'm telling you, you guys want to play the game of the rich, but then you guys get bored of the topics that the rich people talk about. You think rich people are just talking about how they're making more money, right? Well, they are, but they're also looking at how do they reduce all of their tax liabilities? How do they reduce the bills that they're paying, right? That's how they get rich. It's not like, some people will release a song, a new hot song, right? A hit. And then they're rich, they're filthy rich. And that's what you're hoping is going to happen for your life. And it may, right? But you can also win the lottery. That may happen as well. You can buy a scratch off ticket. That could hit you big, right? You can go to the casino and play the slot machine. That can give you a huge payday. And all of those, in terms of percentages, are equal probably in terms of getting rich that way. Most of us, though, and most of the people who got rich, the way they did it, though, is that they invested in a business or some kind of investments, right? They invested and then they worked their butt off to make those investments work, or their business venture, make that work. And then now they have a lot of money. It's not sexy at all. And all the while that they were building up their business, they were reducing their taxes. That's it. In terms of getting rich, it's very simple. Notice I'm using the word simple. I didn't say easy, simple. They figured out a mechanism, this machine of sorts, and they figured out how to make the machine make more money. And then they also figured out how to make the machine run more efficiently, meaning pay less in taxes, pay less in bills, pay less to employees, pay less to everything, right? Have less employees. A business's job is not to have employees. So sorry to burst your bubble, guys, but for everybody who thinks that it's the business's job to support the employees, it's not. That is not the point. That is not the point of the business. The point of the business is to make money. And a business owner who chooses to take this risk, who decides to put everything on the line to make money in this big business or whatever it is, right? When they chose to set out to create this business, they chose to set out to create this business for them and their family. They did not create this business with the idea that in the future they would be hiring you and that they want to pay your way through college or pay your way through adulthood and put your kids through college and all that. That's not why businesses exist. Businesses exist to create money, and they create money by creating value. So they create value, they make money. The person who starts the business, ta-da, win, success, right? It is not to employ you. That's not the point of the business. But the point of the story is that to make money, it's very simple. You create value, you offer to other people, and then voila, you make the money. But there are risks, right? Because the thing that you think is valuable, other people may not consider valuable. So if they don't consider it valuable, they may not pay you for it. They don't pay you for it, then the point of the business was a failure. And that's the risk. That's the risk. But once you create this machine, then you put money into this machine. One day it starts to pays you back. And now, if you put money into the machine and you want it to pay you back, the other thing you want to do is make sure that the money that it pays you back is not eaten up by the tax machine over here, right? There's going to be a tax machine that's eating up at that money that's being paid to you. So if you can reduce that, you get more of the money. That's why I keep talking about taxes. And so this machine, this life insurance machine that I'm talking about, where you're putting money into it and you're putting it into the wealth capture account, as it's called, it's like a checking account. Don't think of it as life insurance. Think of it as a checking account with cool features, really, really cool features. The cool features, hide your money. The other cool feature is that it will provide you retirement money. It will provide you retirement money completely tax-free. I'm reading the comments. My friend Lou Vega says, that is all true. All the information that I'm saying is absolutely true. But this microphone is making the sound crispy, very crispy. So he says, holy cow. I'll put it up on the screen. Wow, that's all true. But that mic is sounding crispy. Holy cow. And good friend Lenny over here was saying, I was thinking the same thing. So I guess the message has no relevance. It's all about the microphone. Yeah, it's good. Here's me reinvesting into my business, buying the microphone. Changes the game, right? Everybody, hey, the rules are the same for everybody. It's just a matter of you taking action and making it better. So this microphone makes these lives so much better, right? And what's cool is I can hear myself because out of the bottom here, I have the microphone plugged into the mic. It's all good. Lewis says, sorry, I ruined it. No, you didn't ruin it. It's all good. It's all good, right? But again, what I'm talking about is people, you guys are working really, really hard. You are. Most people that I talk to, they're working really, really, really hard. The problem is that you guys are paying too much in taxes. And you're doing it because you don't know a better way. Again, why is it that you guys invest in real 401ks? Why? Why do you guys do that? Because that's the only thing you know. And if that's all you know, then that's all you do. And that's the problem. I would love to be able to show you guys better ways. Now, the people in my class like Lou Vega and Lenny and everybody else, they've heard these things. And now that's how they think, right? Their brains are always looking for a new opportunity to either make more money or spend less in taxes and maybe even interest, right? Interest eats away at your finances. Taxes eat away at your finances. If you have all of these things eating away at your finances, you have less money. So all of that hard work you did, all for what? To pay the government? To pay the banks? Usually. And the answer is yes. Usually that's what it is. And that's unfortunate because why? Because you didn't work really hard to learn the strategies. That's it. That's all it is, right? So let me see if I can do a screen share. I can do a screen share. I want to show you guys some stuff here. All right. Let me see. How do I like this? Here we go. This is good, right? You see this? The rich do things differently. So that's one thing that I want to show you, but I want to show you something else actually. And that's a policy. So now this might be ridiculous to be able to see. Let me see if I can zoom in. All right, that helps. Let me zoom in a little bit more. So what I want you guys to see is that here, and this is the nitty gritty, and people don't like nitty gritty. And that's the problem. You guys are going to fall behind if you don't learn the nitty gritty. All right. So nitty gritty. Here we are, $12,000 a year, right? So I'm going to be putting away $12,000 a year in this policy. What's going to happen is some of the money, here's my cash value year one. Some of the money is going to go into my cash value. So I'm going to have less cash, but then I'm also going to have a death insurance policy right here. So if I die, my family gets $500,000. But if I live, I got 9,000 in there. Remember, I paid 12. So this is the cumulative premium outlay, meaning every single year I pay 12 grand and it grows and grows and grows. So by year 5 or 6, right here, year 5 or 6, what you notice is that I'm just about broken even. So I put in 12 every year, and now my cash value is equivalent to how much I've paid. All right. So that means that I've paid 12, or over here I've paid 60, or I've paid 72, and over here I have 58 or a little bit more than 72. And then if you go over here, I have death benefit. So now it's like I put my money in, I have the equivalent in terms of cash value, but now I have free insurance, right? I have free insurance over here. So I'm broken even here, year 5 and 6, but in terms of death benefit, it's like I got free death benefit, and that's just the beginning. Let's go deeper, guys. Let's go deeper. So I put in 84. I have now 87 in cash value. I put in 96. I have 103. I put in 108. I have 120. You see, the snowball is starting. So we keep on going down. Over here, I put in $240,000, and I have $381,000 available to me. But that's not all, folks. My death benefit also grew 1.2 million. So you guys are familiar with term insurance where you pay whatever amount of money and then you're like, "Oh, don't worry, Hone. I got life insurance." And I'm like, "Oh yeah, tell me about it." You're like, "Yeah, I paid $500 and I have $500,000 to cover my family." I'm like, "Oh, that's great." But does it grow? And you're like, "Grow? What do you mean?" I'm like, "Every year you pay. Does that value grow?" And you're like, "No." I'm like, "Well, mine does, right? Mine started at 500,000. It grew and grew and grew and got up to 1.2 million. You're like, "Wow, really?" I'm like, "Yeah." They're like, that sounds good." I'm like, "When does yours end?" And then you say, "Oh, well, I have a 20-year term." 20-year term. Okay. So what happens after 20 years? "Oh, I guess it just goes away, Hone." That's right. It just stops. That's the other problem. It just stops. All right. So let's keep on going. All right. So now we're getting up in age. Here I am at age 58, age 63, 68, right? So let's look. Cumulative premium outlay. At some point, it reduces a little bit. It goes from 12,000 down to 11,800, right? So the money going into my policy, how much I paid into it, it's still growing, but now it's growing at a smaller amount, right? So at some point, I stopped paying. I stopped paying here. This is the age of 70. I stopped paying into at the age of 70. I've put in a total of $394,000, right? And I'll zoom in even more in case you guys know it's pretty zoomed in. So 383 or $394,000 I put into it. Let's look over here. Look at my cash value. $950,000, right? So I put in 394 and there's $950,000 in cash value now. That's a big growth, right? That's like you contributing to your 401k every single year and you hoping that there's more money on the other end once you're done. Not only that, my death benefit grew up to $1.8 million. So if I passed away right here at the age of 70, my family, they got that $1.8 million. Remember, I kept growing. But not only that, remember after 20 years, yours stopped? This is 33 years later. This is not term policy. This is policy until I die, which is crazy because they are for sure going to pay out. I don't know how this math works, right? But take a look at this. Let's call this 400. I'm tired of saying 394,929. Let's just call this 400,000. I paid in 400,000, but the insurance policy is going to pay out 1.8 million, right? But that's not what's sexy. I mean, it's cool and that's good for my family and everybody, right? That's how you leave generational wealth and legacy and all that kind of stuff, right? So $1.8 million. But what's sexy is the cash value right here at $950,000. Okay, so we have a question. Lenny asks, would your family get your cash benefit as well as you pass before your distribution? Hold on. Would your family get your cash benefit as well if you pass before your distribution. So Lenny, no, the answer is no. This cash value you do not get. But while you're alive, I'm going to show you that you should take it. Right now, in this diagram, I'm going to show you how I'm going to use the money passively. And so if you guys think about this, I want you guys to think about this. This insurance policy is for you to create a passive income machine once you're ready to take the money from it. Okay. So if you guys notice right here, right in the middle of the screen, it is $71,000, right? This means I am pulling out, and this is the income tab, okay, or the income column. Income column is $71,000. So up to this point, I've paid into it $400,000, $394,929, right? I put in that much money. That's it. That's all I put into it. But I pull out $71,214, and then the next year I do it again. And if you notice over here, this says zero. I stopped paying into the policy. Okay, I stopped paying into the policy. I'm pulling money out now. This is my retirement years. This is my passive income machine, right? So I pull out 71. I pull out another 71. I pull out another 71. And I keep doing it year after year after year. You see all these zeros? I keep pulling the money out. Remember, guys, this life insurance machine was built for you to be alive. This is not something that you buy for the death benefit. Though it has a death benefit, this is not for just for death benefit. This is for your life while you're alive. And so here I'm at the age of 71. And then here we're designed where I croak at the age of 88. Okay. From 71 to 88. So all of these years, I'm taking out 71, 71, 71, 71, 71. So let's do some math, right? So this is 18 years. So I take out my calculator. Right? Take out my calculator. I do 18 years times 71 to 14. That is $1.281 million, folks. 1.21, whatever. $1.281 million that I pulled out of this policy while I was alive, and I've only put in a little less than $400,000. You guys see this? This is a retirement account for you guys. It's not just death benefit for when you die and your family's like, oh, thanks, Dad. No, that's not that. This and this money, the $1.2 million that you're pulling out, $1.2 million that you're pulling out, that's completely tax-free. Completely tax-free. Don't tell anybody. Right? If you guys had $1.2 million in your 401k and you were trying to retire, cut that in half. You'd have roughly $600,000, $700,000 because you have to pay the tax man or the tax woman, whoever it is, when it comes time for you to retire. You're gonna have to pay taxes on that. This money I don't have to pay taxes on, right? So I don't have to pay money on that. I don't have to pay taxes on that. Not only do I not have to pay taxes on that, right? That money is going to be there. It's not tied to the market. It's not going to fluctuate with the market. That money will be there. So far what I've told you guys is that this money, while it's growing at a really rapid pace. The problem is that people don't have the patience to allow it to snowball. But the money in there is growing and growing and growing and growing, right? And then what happens after that is eventually you can access it. Now, let's talk about while you're alive, okay? Let's talk about while you're alive. And let's talk from the standpoint of being a real estate investor, okay? So now in our classes, we talk about using hard money lenders. We talk about using private money lenders. We talk about using seller finance and subject to and all of these different strategies, okay? So now let's say I have $138,000 in cash value in there. What I'm going to do is I'm going to take a loan out from this policy. And notice I said loan. I didn't pull the money out. The reason I don't want to pull the money out is because if you take a look from 120,000 to 132,000, right? That's a jump of 12,000 out of my pocket. Okay. You guys see that, right? I put in 12, right? I put in 12 from here to here. It turns to 132. That's how much money came out of my pocket. If you look over here, From 138, 658, it goes to 157, 574, meaning I put in 12, I got back 18. Over here, I put in another 12, I got back almost 20. I put in another 12, I got back 21. I put in another 12, I got back 22. Right? You guys see that growth there? And that's year after year, and year after year, it's growing. It's getting faster and faster. Right here, I put in $12,000. I got back 30,000. But not only that, don't forget, I still have this cash or death benefit that's growing too. So let's go back to this 138. Let's say I borrow against that 138. That means that the next year I will still have 157 because I took a loan against it. I didn't pull the money out. I want you guys to understand that. I didn't take the money out of the bucket. I borrowed from it, right? I borrowed from it. So I borrowed, let's say I borrowed 20 grand, 40 grand, right? I borrowed 40 grand from there. And then I put that with a hard money loan. So I got a hard money loan and then I got a loan from my life insurance policy. I put the two together and I used that money to buy another property. With that property, I fix it up and then I refinance or I sell it. Doesn't matter. You pick whatever strategy you like. And when I refinance, I pull the money out and I pay back my loan, right? I pay back my loan. Here's what's really cool. A hard money lender usually has a monthly payment schedule. So they're saying, like, if you borrow the money from us, you're going to have to pay back every single month. If you choose to, and that's it, right? You owe us every single month. Here, if I pull out $40,000, there is no repayment schedule. I don't have to pay it back ever, right? Technically, I don't have to pay it back ever. And if I die, the death benefit covers the loan. So I have no loss. The reason I want to pay back my loan, though, is because I want to be able to get another one later. I can only borrow against how much I have in the cash value. So if I already have a loan outstanding, I want to pay that back so that the next time I need the money, it's there. So if I borrow 40,000 from 138, then I still have 98,000. Actually, I have 90% of 138,000 that I can borrow from. So whatever 198,000 is. Actually, let me do the math. Let me be specific. 138, 658 times 0.9. We have 124,000. So if I borrow 40,000, I still have $84,000 to borrow against. So I still have 184,000 I can borrow against. But what if I needed to borrow 100 grand and I had the 40 out already? That's where I get screwed. So instead of not paying back my loans, I borrow it and then I pay it back. I don't have to though, but I should, because this little machine here is what's going to be giving me the money so that I can do more deals. So if I were to show you guys in a visual, let's see if this works. Okay, so here's the cash value, and then here's the loan against the cash value, right? I borrow the money, and then I pay back, or I buy the house, and you see this little building down here? That's the bank or the hard money loan, and I use their money. So I combine the two, right? I combine the two, and I buy the property. Now, I do owe 5% to the loan, right? That's the interest that the loan cost me. So I pay that back from the cash flow. And then when I'm ready to refinance or sell the property, I sell it or I refinance, and then I pay off the whole entire loan after that. So that's the right way to use it. And notice I'm over here and I'm hiking, right? And that's because the cash flow from the house is paid to me semi-passively. And I say semi-passively because you still have to take care of the tenants and all of that kind of stuff, right? But that's the strategy. Now, here's another strategy that people overlook. Maybe I take the loan out against the cash value and I lend it. Maybe you want to be the real estate investor and I have a huge cash value portfolio, right? Or a huge cash value position within my life insurance policy. I lend the money to you. You go do your deal, right? You go do your deal. And then when you're done, the cash value or the cash flow goes to you. You pay me, I pay back my loan. I'm over here hiking. I don't care. And then you choose to refinance or you choose to sell the house, whatever you want to do. Just pay me back and I'll pay off my loan. But all the while you got the money, I'm making the spread, right? I'm making the spread between the 12% and the 5%, right? Interest rate arbitrage right there. Interest rate arbitrage off of a cash value policy that is growing at that super fast clip. Now, I'm going to show you something again, and I want you guys to pay attention to this. This one kind of loses people sometimes. So remember over here, I said I paid $12,000, right? In the beginning, I paid $12,000 to the policy. Well, $9,000 goes into cash value, and some of it buys death benefit. So it's buying two things. I got cash value over here that I'm paying for, and I'm buying death benefit over here, which I'm paying for, and I'm paying for it with the $12,000. So how much goes towards death benefit? How much goes towards cash value? Right? Think about that. How much goes towards death benefit? How much goes towards cash value? Well, if you do this, if you look at it this way, I want to say that 30% goes to death benefit and then 70% goes to cash value. So every time I pay $12,000, 30% goes to death benefit, 70% goes to cash value. So if you do math, and math solves all, $12,000 goes to the death benefit. So if you take $12,000 and multiply it by 0.3, which is 30%, that is $3,600. So that means towards the cash value. So every time I pay $12,000, I'm paying $3,600 to death benefit, and I'm paying the rest, $8,400, towards cash value. So let's look at what happens then. That means over here, I have cash value. I'll zoom in a little bit. Cash value over here, year one, like we said, we were doing the math. I put in 84, but year one, I had 94. I made $1,000. That's a 12% return on my money. Over here is the death benefit. I paid 36, but I got 516 in return in terms of death benefit. I pay 36 again. It's a little bit more. I pay 36 again. It's a little bit more. It's constantly growing. Look at that. Keeps on going. Year 20, I pay 36. I have 1.2 million. And you saw that from the other graph. If we come back over here, this is what's nuts. If there was a magical slot machine where you put in $8,400 and 9,400 popped out, that would mean that slot machine gave you a 12.75% return. If you did it again and this time it popped out 10,000, you got a 23% return. You do it again and it pops out a little bit more and more and more and more and more. That's what's happening. That's the policy that I showed you earlier in the other screen. That's how much you get in return. This is it added up. 9,471 plus 10,374 is 19,845. It's growing like this. Boom, 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 boom. Remember, I said I borrowed 40,000 from my 138,000. That's here. I put in 8,400. I got back 17,934. That's 113% return. That's a hell of a magic slot machine there. Do you guys see that? This is the power. This is the power. And before you know it, this cash value is super high. But also, I'm pulling money out. I'm pulling this money out every single year when I'm in retirement age, and I'm not looking to pay it back. $1.2 million I pull out for my retirement. And the most I ever put into it was $400,000. That is bananas. All right. That is bananas. Let me show that part to you guys again, right over here, right? I keep pulling out all this money, 71, 71, 71, 71. I keep pulling out all this money until I pull out $1.2 million worth. And that is all, that's all tax-free income that I got for my retirement. Tax-free. And it didn't go down, right? Final strategy I want to show you guys. Here's the subject 2. This is a hot topic. People are doing subject 2. They're talking about this a lot. So that's where you buy a property from somebody who is looking to just sell their property. They have a mortgage on it, but they're willing to give you the property as long as you pay the mortgage. Now, the mortgage companies don't like that. They don't like when you just take over a property out paying off the existing mortgage. So what happens is there's this thing called a due on sale clause that they can call. They usually don't. If you pay your mortgage, they usually don't call it. But if they do decide to call it, at least you have within your cash value the ability to take a loan out, pay off the bank, and now you own the house with your own money. And then if you want to refinance it and get your money back, you can. So I call this a subject to safety net, right? Subject to safety net right here. You have the money just sitting there on the side. You notice how there's no arrow from the cash value over to this scenario. It's just a safety net. In case they call the loan due, you can pay it off. But you don't have to if you don't want to, right? So you guys see how this insurance is so much more than just money that when you die, somebody gets paid. This is so much more than that. This is how the poor and the middle class look at it. But if you just sat through all that I just talked about, you will see why I'm so excited for this stuff, because these returns are crazy, right? These returns are crazy. Show me where you're putting 8,400 in, and then over here you put in 8,400 and you get back out 30,000 without you doing anything. Notice this money is growing without your input. It doesn't need you to be a good, sophisticated operator. You're not doing anything for this money to grow. Other people will be like, well, Hone, I can beat that. I can beat that return by doing this and by doing that. But right, you're doing it. Beat this return by doing nothing. And then we'll talk, right? And then I'll get involved with whatever you're doing. But most people can't do it. That's why this is the real passive income machine. This thing is growing without you being a specialist. This isn't growing without you being some kind of amazing operator. Now, you can make all kinds of returns in real estate and stocks and business and all that kind of stuff. Absolutely. And lots of people have. But how do you make this return without doing anything? This is like that slot machine I was telling you guys about. You put $1 in and $2 comes out. That's where are we at? Right around here. I put $1 in, $2 comes out. I put in 8,400, 16 comes out, right? 100% return. Well, here's the slot machine that I once told you guys about, but then it gets even better. Over here, it's almost like I put in $1 and then $3 comes out or $4 comes out. Over here would be I put in $1, $3 comes out. Over here, it's almost like I put in $1, almost $4 comes out. It's crazy, but it's real. And this is how the rich do it, right? Remember, this is how I started the presentation. The rich do things differently. That's it. They just do things a little differently. It's not that you don't have these tools available to you. It's just that you never learned how to use them. That's it. That's the only thing. So, does anybody have any questions about any of that? It's really exciting, right? Once you guys start to understand and see what's going on, it's like, oh my gosh, why didn't I get into this before? I think I titled the video something like "I'm upset," like, or my life insurance agent screwed me, and what I mean by that is that the way that they were telling me about life insurance isn't the way I'm telling you about it, and the reason is for a couple of things. The cash value that's built up in your policy is highly dependent on how the agent set it up for you. It's one, how the agent set it up for you, and two, whether the product that they pick with the company that it's with, it's determined by that. If I went back to this slide, this one's very important. This is the dark little secret, okay? This one's the dark secret of life insurance. And this is why I feel like they screwed me a little bit. So what happened was the insurance agent is paid from the death benefit. Okay. So I want you guys to get this. Insurance agents, life insurance agents, are paid on how much death benefit that they sell you. So if you are a life insurance agent and you were like, okay, I'm going to go out and make as much money as possible. How do I do that? What you would do is you would make it so that instead of a 30% to death benefit and 70% to cash value, you would flip flop it. You would put 70% to death benefit and 30% to cash value. You would switch that around because that would maximize your commission. And what that does also is it screws me as the policyholder because my cash value isn't growing. This doesn't become a very good tool for me for building wealth because all my money is trapped in death benefit. It's a really cool tool for my family when I die, but it's not a cool tool for me while I'm alive. Okay. But what happens now is that because I look at it, right? Somebody's like, hey Hone, do you want this whole life insurance policy? And I'm looking at it and I'm looking at the cash value. I'm looking at all the numbers, right? I'm looking at the policy and I'm like, to be honest, the answer is no. Like here, the cash value is high and it grows quickly. But in other policies, sometimes this first year or first 2 years, it actually says 0. And because it said 0, I was like, well, this is a terrible policy. Why would I want to do this? And so I never did it. And so then what happens when you don't do it is that you don't begin getting this snowball effect of where, yeah, first year, this much goes in, next year, that much, next year. I could have been where now 10 years later, I think the first time I heard about life insurance was maybe 15 years ago. But if I had met somebody 10 years ago, I could be putting in my money here. I could be paying the 12,000 and I could be getting 19,000. So I could be at that juncture, but I'm not. And I'm not at that juncture because the person who tried to sell me the policies, they weren't there for my best behalf. They were just looking for a high commission. So when I learned about how powerful these policies were, I said to myself, wow, I could really help people with this. They need to learn about this. And I got to stop people from getting taken advantage of by these other agents. This policy stuff can be very confusing. It can be very, very confusing. So I understand why when presented with a policy, you don't know what you're looking at. You're just like, okay, I guess, right? I don't know if this is a good one or a bad one. I don't know enough to know. I heard a funny joke once, or a funny thing once. The guy said, every time I go buy a new car, the salesman, he pops open the hood and I take a look at the engine and I just stand there and I look at it, but I don't know what I'm looking at. All right, looks good. Close the hood, right? Because I don't, if you don't know, you don't know. What are you going to see? Okay, it's an engine, right? Same thing with these policies. This is you looking under the hood, looking at all these numbers and all that kind of stuff, and you're just like, yeah, it looks good, I guess, right? But then I realized that people have been taken advantage of because these agents just want the highest commissions possible. So they sell you a policy that doesn't benefit you while you're alive. And you just look at it like this policy sucks. So then you don't get one. And then when you don't get one, what do? Well, you got to do something with your money. So you put in your checking account, you put in your savings account, you put in your 401k, and that's that. And then whatever is left, I mean, you kind of spend it. So if you knew about this sooner, you would start this sooner. And then you would have this like doubling effect or tripling effect sooner than later. That would change your life completely, right? That would change your life completely. If you knew more, you'd do more, right? If you knew better, you do better. And these life insurance policy or life insurance agents, they didn't necessarily watch out for your best interest. They say they have a fiduciary responsibility. They don't care. As long as they're not breaking the law, they don't care that they're overcharging you for these policies. They don't care that there's no benefit to you while you're alive. They just care that they got paid and that they can pay the bills, right? So when I learned about this, I was like, I got to get into the business and I got to get people these policies so that they can start building their wealth and then they can start loaning themselves money so that they don't have to use a hard money lender completely, or they can use more hard money lenders because they have more money for maybe the closing costs or the points or whatever, right? So you can start building your wealth faster and more securely by having this policy. Again, this is what the rich people do. This is the rich do things differently. That's just it. The rich do things differently. This policy was always available, but I never had any rich friends to show me what I just showed you. This little thing, so many people just like they brush over it. Oh, wow. Hone showed me. Great. Dude, you guys have no idea. Like the what I reveal to a lot of people or what the insiders, like the rich families, is what they do. But people take for granted that I'm your friend and I do all the work and the research and I read and pay for seminars and do all these things and I got the inside scoop of how these things work and then I come to you with my skill of being able to teach. I have this ability to teach and break down things very in a very basic manner so that you can understand it. I take a really complex thing, I make it really easy. Then you're like, "Oh, I get it. Well, that's so cool. That's amazing. I should do that." Right? So people take advantage or I'm sorry, they take for granted that they know like that they're learning from me. But that's the problem. Because I'm giving it to you for free just like this, it seems like it has no value. Whereas this has immense value. It has immense value. Most people don't take advantage of the things that are there for them. And then they like to complain about the 1% having all the benefits and they don't pay taxes and yada, yada, yada. It's all there for you. And I'm giving it to you guys right now. But you have to be able to see the power in what I just showed you. It's all numbers. It's all numbers. And you guys, oh, I'm bad at math and I don't like numbers. Well, then you're going to have a tough life because everything costs money. You're going to have a real tough life because everything costs money and numbers are what tells you how much money you have. So these things, this little strategy, as powerful as it is, it's only powerful if you take advantage of it. In my life, I didn't take advantage of it until later in life. And so now I'm trying not to waste time. So I'm taking advantage of it and I'm also teaching other people how to do it. If you'd like a policy, let me know. Just email me and you go to my website. It's scrolling at the bottom there, honesloans.com. You can go there and check me out. But if you want a policy, just send an email, put your name, your age, your gender, and your state. Oh, and if you smoke or not. That's the difference. If you smoke, the likelihood of you dying sooner is higher. So they have to account for that. Now, we can still give you a policy. We can still write you a quote. It's just going to be more expensive if you smoke. So smoking costs you twice. You have to pay for the cigarettes and then you have to pay for everything. Your insurance policy is going to be higher. But it doesn't matter. Just start building wealth, right? Start building wealth and then you can buy all the cigarettes you want. I'm just kidding. Don't do that. But again, your name, your age, your gender, whether you smoke or not, and then what state you're in. And then we get a policy quote, right? Oh, tell me how much you want to pay for it too, right? Damien, you said you're still waiting for your policy. That's not true. I sent you your policy. You looked at it. Oh, but anyway, we're going to start, Damien. We're going to start your policy very soon. So see, Damien, he sat through my first presentation. He's like, yeah, I want to do this. So we're adjusting it, right? So we sent him a policy and then there was adjustments. It's like, okay, let's do this. Let's do that. Oh, and let's talk about putting more money into it. Somebody reached out to me today and he started asking me all these detailed questions. And I was like, huh, you started doing your homework, huh? Because I was like, these questions that you're asking, you just don't think of them. He was like asking about mech limits and all that. Those are like specific questions. You just don't know to ask those things without doing your research. And I said to him that I am very happy that he's an educated consumer because the more you learn about this stuff, the more money you want to put into your policy. Because when you're starting out, you don't really know much about it. What happens is you look at this like a cost. Oh, I don't know if I want to put that much money into it. When you're an educated consumer and you realize the power of this money growing and growing and growing and growing, right? When you're an educated consumer and you realize how much money grows and snowballs over time, you don't look at it and say, oh man, Hone, I don't know if I can put that much. To Hone, how do I put more? Hone, how do I maximize the amount of money that I put into this thing? How do I shove as much money into these policies as possible? So it goes from one spectrum to the other. And it only goes like that by education. Because if you look at this as an expense, you do what you do with everything. What is the smallest thing that I can start with? versus an educated consumer goes, how do I maximize this thing, right? So when I first started in adulthood, actually, I would say things like, oh, debt is bad and I don't want to have any debt and I want to reduce my debt and all that kind of stuff. As I got smarter, I would say my goal is to have more debt. And so technically I have millions of dollars in debt right now. And people are like, oh my gosh, Hone, you have millions of dollars in debt? And I'm like, yeah, I do. They're like, oh my gosh, I have $30,000 in debt. And that freaks me out. I can't I can't imagine having millions of dollars in debt. And I think to myself, do you know what my debt is for? Right? It's obvious, like for you guys who know me, and I don't even have to say what my debt is for, but you guys already know. And for those who don't know me, my debt is because I own real estate. I own a lot of real estate and I use debt to buy the real estate. So I might have, for example, I might have $100,000 loan out, but I own a property that's worth $150,000. So you see, in that one scenario, I have $50,000 in equity. So if I had $50,000 in equity for every $100,000 I have out, my question to you would be, how much debt do you want, right? How much as you can get, because the only reason you're taking the debt is to buy more assets that have equity. Every time I buy a property, I get richer and richer and richer. Yes, I take on debt, but the assets that I'm buying with that debt are very valuable. So I'm getting richer as I take on more debt. For most people, more debt you accumulate, the poorer you get. And that's the big difference. That's the big difference. We have a question. What is the state, or what states have the lowest premiums? I'm curious. I have no idea. I don't know. I guess that would be like the safest states, right? I don't know. It doesn't really matter. You just kind of have to pick your state that you're in and then just buy it like that. Don't worry about those little details. Don't try to don't be fraudulent. Oh yeah, I live in this state. No, you don't. People do that with car insurance, right? Some states or zip codes or cities or whatever have lower car insurance rates. So they'll say that they live in that. That's technically insurance fraud, and people get in trouble for that and go to jail. But yeah, the when I started adulthood, I didn't want debt. And then as I got financially savvier, I realized that debt can be good or bad. And then if you got more good debt, that means you got richer. And so I graduated from the I want no debt to I want more debt. Give me more debt. How do I get more debt? And that's it. Just people can't wrap their minds around it. And that's okay. It's not for everybody. I guess having wealth is not for everyone. Even though they say it, it's not for everyone because their mind is not there to absorb it. Right? Your mind is not there. And if it's not there, it's not there. And it's okay. You just weren't designed to be wealthy. And there's nothing wrong with that. Not everybody's supposed to be wealthy. And not everybody should be wealthy. And not everybody cares to be wealthy. And it's not a judgment at all. I want to be wealthy. Maybe you want to be wealthy. Maybe. I know I want to be it. So I keep focusing on financial intelligence. And so, like I was saying before, the people who are more financially intelligent and ask good questions about life insurance premiums and policies and things like that, it goes from, Hone, what's the smallest policy I can start with? To Hone, how do I shove more money into this thing? How do I shove as much money into this thing as possible so that I can do more and more and that I can set myself up securely for my future so that when I retire at the age of 65 or 70 or whatever age, it has all of this money in there so that I can start pulling the money out completely tax-free. And it feels good to know that that money is safe and securely in there. Big difference, right? Big difference. It's crazy. It's incredible because the difference, right? You might you start off with like $300 a month or $500 a month, right? And then you're like, okay, maybe I'll do 1,000 and then 2,000, right? And then like those little differences, like 1,000 here or there or 500 here or there, it seems like a lot, but then at the same time, in the grand scheme, it's not a lot. But then in terms of how big your cash value grows over here, it's like huge. You're just like, oh man, if I put this little bit more in here to go over here, it's that much bigger. And that's what's incredible. That is what's incredible. So, I spoke for an hour and 5 minutes about nothing. I just rambled. I had no script, no idea what I was going to talk about. I just started. Boom. All right. Next question. How soon can you borrow your cash benefit or cash value, actually? Immediately. Like as soon as you have cash value in there, you can access it immediately. So the policy that I showed where I made a $12,000 payment. So that's it's an annual $12,000 in, and I have immediate access to whatever cash value is in there. Boom, right out. And that cash value goes in. Again, remember when I was talking about bad life insurance agents? They'll set you up with a policy that has zero cash value in there, and you can't access it. The policies that I can create for you guys now, you have immediate cash value and you can access it immediately. So don't think of it like, oh, Hone, if I give you this money, right? If I give you this money, then I won't be able to use the money. So then I can't do this opportunity. That's completely wrong thinking. You give me this money, I can now lend it back to you and you can do whatever you want. If you wanted to go buy a property or a car or whatever, you can. You have immediate access to your money. But not only that, once your money gets into the system, the snowball starts rolling down the hill. Boosh. That's how you get rich. That's how your wealth grows and grows and grows securely. Securely. When you're starting off in this game called wealth generation, all you can think about in the beginning is, how do I make more money? How do I make more money? How do I make more money? Eventually, you think, man, I've made all this money. How do I protect this money? How do I hide this money? How do I make it so that I don't have to pay taxes on this money? Right? All right, we got a question here. Jason says, do you pay premiums for the rest of your life? Well, you don't have to. And you can do a 10-year pay. You can do a 20-year pay. You can do whatever you want. But for me, I wanted to do a maximum cash value play. So let me pull up the screen real quick. So let's look at this policy. Let me zoom in a little bit. All right. So I stopped paying here. So here I kept paying into it for 33 years until the age of 70. At that point, I'm like, okay, I'm done. I'm going to retire. I'm going to start pulling money out. So let me see if I can zoom in even more. Okay. So here, 33 years old. And actually, let me see if I pull the question. Okay. So here, 33 years later, after the start, I'm at the age of 70. Okay. So at the age of 70, that's my last payment, $11,893. Year 34, see this little 1? That means I'm starting the retirement part, right? Age 71, I stop paying into the policy and I take 71 out. The reason that I pay as long as I possibly can is because look at it right here. Let's see. Hold on. What am I looking at? Total change in cash value. Okay. So this is incredible. Right here at age 68, we'll get this 68, 69, 70. I want you guys to focus on this real quick. I pay $11,893 this year. My policy grew by $52,000. This year I pay $11,893. Then it grew by $54.59. You notice the difference here? You see my cash value? See it jumped? It jumped $52,000, jumped to $54,000, jumped $57,000. You see that? From here to here, $57,000, here to here, $54,000. Actually, it's from here to here, which was $52,000. See the jumps? Crazy, isn't it? And then I start taking the money. I take $71,000. But you see the crazy jumps that I'm having, right? You see, it went up $300,000 from the age of 63 to the age of 70. right? It jumped from here, 600,000, 1 year, 2 years, 3 years, 4 years, 5, 6, 7. 7 years, it jumped $350,000. In these 7 years, it jumped $350,000. But if you add this up from here to here, that's only a jump of, it looks like 83,000. So I pay in an additional 83,000 and it jumps an additional 350,000. So for me, in this design, I'm paying until then. If you want to design it where you stop paying earlier, you totally can. That you totally can do it. But I keep paying into it so that I maximize the snowball effect. The longer you hold it in there, you see how the snowball gets bigger and bigger and bigger and bigger, right? Boom. Then you start taking the money out. From 71 to the age of 88, when I croak, boom, I've taken out over $1.2 million out of this policy, and I've only paid into it 394. See that, guys? 394,929. You see how that number didn't change? It's because I stopped paying into it. But I've taken out $71,000 every single year, bing, 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 to the tune of 1.2 million, almost $1.3 million. But great question, Jason. Anyway, really cool stuff. A lot of numbers. I know. It's really not that bad, though, because you guys are an adult. That's why it's not so bad. For you to say, like, oh, I'm not good at math and I don't like numbers, like, that's a very childish thing to say. I would like to add. Don't do that, because you're just cutting yourself. You're just cutting yourself at the legs when you say that. When you put limitations on yourself, like math, it's a really bad thing. I saw a meme. It said, I see these guys who are 30 years old put the middle finger up in every picture. It's like, bro, what are you mad at? Your credit score? At some point, we don't play like that anymore. We don't pose in pictures giving your middle finger. Like, that's not how you do it. Like, you're an adult now. Don't do that. Don't do that stuff. Right? And as an adult, don't shy away from math, because I'm going to guess your car loan has interest payments and has depreciation and has taxes and has closing costs and all that kind of stuff. All numbers. When you buy a house, the agent has a percentage, and then the title company has percentages, and the pricing and the bank loan. It's all numbers. Everything has numbers. Don't shy away from the numbers. So when I go deep into the numbers, when I show you all these things, don't shy away. If you want to have a really good life where you're not always working, then you better learn numbers, because what you got to do is figure out how to increase your return. How do you increase your returns on your money? So if I go back to this, right? If I go back to let me go here, right? If I go back to this screen, right? Look at these returns. You see these percentages? They're crazy. Like, where are you getting 200% of return on your money? 200% is where you put $1 in the machine and $3 comes back. The $1 replaces the dollar you put in, and then you got $2 in profits. That's what's happening here. This year it's 17. You put $1 in, you get $3 back. I know it says 200%. Remember, be good at math, and then you'll follow along. You can be, oh yeah, the first dollar is the one that replaces the dollar I put in, so that's break even, and then I got $2 extra. That's 200% return. Right? How else are you going to get that money? And how else do you get that money passively? Right? That's the key. How do you get that money passively? A lot of people can be like, oh yeah, Hone, I can make money. I can buy a car and I can fix it up and I can sell it and I can get a 200% return. Yes, but you got to go find the car, and then you got to fix up the car, and then you got to sell the car, and all of that's work. How do you make that return passively? So that's the question. But anyway, thank you guys for participating. Thank you guys for asking the questions. I hope you guys get started with these policies. Also, if you already have a policy, whether it's a whole life policy or an IUL policy, you can do what's called a 1035 exchange. And that's where you roll your cash value from whatever policy you have. You can roll it over into this policy, and then and it's kind of like you're starting new with this policy, but the cash value you brought over. Okay, so that's called a 1035 exchange. And so a lot of people have been interested in doing that because they've been sold a policy that's not as efficient as this one. It's not as efficient and effective as this one. And the agent that they're dealing with doesn't know what they're doing. They don't know anything about investments. They don't know how to use the cash value to buy more investment properties. They don't know any of those things. So if you guys want to work with me and figure out how to use your cash value, well, you got to become one of my clients, and then I'll gladly work with you. So you can roll your 1035 over cash value over into a policy that I create for you, and then we'll get to work. I'm excited for that. Right? I'm very excited for that. I'm a real estate investor first. I'm a business owner, entrepreneur, right? And I'm an educator. So if you guys are interested in working with me, then let's work, right? Go to my website, honesloans.com, hit me up, message me, and then we can begin looking at different policies. And then we'll grow. We'll grow the policies, we'll grow your assets, we'll get you into more debt. Remember, millions and millions of dollars in debt, because there's good debt and bad debt. We'll get you millions of dollars in good debt. You own tons of policies, or you own tons of assets, whatever it is, right? I don't know what's going to happen for you. I have no idea. And you know what? Maybe nothing can happen to you. But I know that if you spend your time if you spend your time to build up your financial education and your intelligence, you can do so much. You can do so many things in life. And it's up to you to dictate, right? Nobody holds the key. You don't have to apply for this job. You can create whatever life you want based on what you know. So the more you know, the more you can do. All right, well, it's a good time to end this video. Again, thank you guys for watching this. Thank you guys for the questions and participating. I love that you guys are interested in building your financial intelligence. And if you guys are interested in starting a policy, let me know. Email me. Again, I just need your name, your age, your email. Well, if you're going to email, I don't need that. Name, age, gender, whether you smoke or not, and what state you're in. And we'll get started. All right, guys. Well, with that, thank you so much. And I will catch you in the next video. See ya.